Imagine a country with the greatest natural resources on the planet, a giant destined to be the next superpower. Now, imagine that same giant building a wall around its own economy and locking it from the inside. While the world is distracted by wars and AI, something unprecedented is happening in Latin America's largest economy. In 2026, Brazil is just changing its laws. It is activating what Wall Street analysts call the ultimate trap, a new tax system so aggressive it is transforming investments into liabilities overnight. The major sovereign wealth funds have already begun their silent exodus. If you have a single dollar invested in emerging markets, or if you believe your assets are safe in a centralized system, what is happening in Brazil is your final warning. Today, we reveal how the Brazil cost became a death sentence for foreign capital and why 2026 is the year the gent decided to consume itself. Welcome to How Systems Work. Brazil is on the brink of conducting a radical economic experiment. The math of survival for any business there has fundamentally changed. While most developed nations keep their value-added tax, or VAT, around 19%, Brazil is preparing to launch a combined federal and state rate that could soar to nearly 30%. That's not just high, it's a world record. For an investor sitting in London or New York, this isn't a simple reform. It's a form of indirect expropriation. Think about it. When the state becomes your primary partner, taking almost a third of your gross revenue before you even pay your employees or suppliers, your business model ceases to be an investment. It becomes a forced charity for the government. This single change is enough to make global capital question if the risk is worth the reward. But this is just the beginning of the story. Capital's greatest fear is just high taxes, its crippling uncertainty. And that's exactly what Brazil is offering in 2026. The transition to this new system is creating a state of administrative chaos that some are calling Schrodinger's tax. Companies will find themselves in a fiscal limbo. The old, complex system ain't dead yet, but the new one ain't fully operational. This means businesses will have to pay and report taxes under two different, conflicting systems simultaneously. The compliance costs, the legal fees, the sheer manpower required to navigate this bureaucratic nightmare will be astronomical. For many businesses, their profit margins simply won't be able to sustain it. Brazil is essentially asking investors to leap into an abyss without showing them where the bottom is. It's a gamble few are willing to take. Then there's the so-called selective tax, which critics are calling Brasilia's new weapon for moral control. On the surface, it's designed to discourage products and services deemed harmful to health or the environment. But the danger lies in its vague definition. Under this new rule, the government gains the power to punish any industry it chooses, from mining and oil to agriculture, with a single stroke of a pen. An administrative decision, not a legislative debate, could designate your sector as the villain of the week. For a foreign investor, this means your entire business model, your projected profits, could be annihilated overnight without any warning or recourse. This isn't just a tax, it's the end of legal certainty, a cornerstone of any stable investment environment. Capital needs predictability, and this new tax creates the exact opposite. The world is rapidly moving toward a digital, service-based economy. But Brazil's 2026 tax reform seems to be looking backwards, taxing the country as if it were still 1950. The technology and services sectors, which are the heart of modern investment and innovation, are set to suffer the heaviest blow. Under the new system, these industries will see their tax burden skyrocket. For global software companies, consultancies, and digital service providers, the cost of doing business in Brazil will become prohibitive. The result? Brazil risks ceasing to be an innovation hub. Instead of attracting tech talent and investment, it could become a market where global companies only focus on salvaging what's left of their operations before pulling out. It's a direct tax on the future, in a world where the future is digital. Now we get to the point that keeps CEOs and CFOs awake at night, the black hole of tax credits. In theory, a VAT system is supposed to be fair. You pay tax on your inputs, and you get that money back as a credit against the tax you collect on your sales. It sounds simple, but in Brazil, a tax credit is often a one-way street. The money goes into the government's coffers, but it never comes back out. For a multinational corporation, having millions of dollars in capital trapped in tax credits that the government refuses or is unable to return is catastrophic. It's dead capital, frozen in a system that demands liquidity and agility. This isn't just a bureaucratic delay. It's effectively being robbed in broad daylight, with your own money held hostage by the state. This issue alone is enough to deter any serious long-term investment. If you want to know where an economy is headed, don't just listen to politicians. Watch where the smart money is going. And right now, Brazilian smart money is fleeing. The country has owned billionaires and high-net-worth individuals are moving their assets and their families to places like Portugal, Miami, and Dubai. This isn't a vacation, it's a capital exodus. When domestic capital, which understands the local landscape better than anyone, decides to leave, it sends a powerful signal to the rest of the world: the ship is sinking. Add to this the planned increase in inheritance and dividend taxes in 2026, and you have the final nail in the coffin. Brazil is effectively telling its most successful wealth creators that they are not welcome. And you can be sure the rest of the world is hearing that message loud and clear. Brazil has always been an expensive place to do business. The infamous Brazil cost has been a deterrent for decades. But the country always had a secret weapon: competitive incentives. Different states would compete for investment by offering tax breaks and other benefits, creating pockets of opportunity. From 2026, that advantage disappears. The new reform centralizes tax collection, ending the fiscal competition between states. Without those regional incentives, and now burdened with what could be the highest tax rate in the world, Brazil loses its only real defense against more competitive emerging markets like Mexico or India. The Brazil cost is no longer just a hurdle to overcome. It has become an insurmountable wall, locking capital out. So what does this all mean? What we are witnessing in Brazil isn't just a local drama. It's a critical case study of how a state, desperate for revenue, can suffocate its own future to pay the debts of the present. The system is being engineered to work for those who control it, not for those who produce and create value. Investors aren't leaving Brazil simply because of higher taxes. They are leaving because they have lost faith in the system's ability to be fair, predictable, and transparent. In the high-stakes game of global capital, trust is the only currency that truly matters, and once that trust is broken, it can take generations to rebuild. The Brazilian trap is teaching the world a powerful lesson. When the government becomes the primary beneficiary of your work, the only logical move is to stop working for it. Subscribe to How Systems Work to understand the next domino to fall. Because the system only works if you don't know how it works. Until next time.